Hi everyone. Let us see another question on risk management. This is also on currency rate risk management. The usual requirements are there: forward contract, futures, options, and then there is an additional requirement which can be considered to be slightly different. Kind of a unique type of requirement is there. We will see one by one. The following exhibits available on the left hand side of the screen in the CBE exam provide information relevant to the question. F company hedging a payment, alternative exchange rate scenarios as at 1st of August. This information should be used to answer the question requirements within your chosen response options. Exhibit 1. Frongoch Company hedging a payment. Frongoch Company is an American company with a centralized treasury function based in the US. Today's date is 1st of March. F Company's treasury team is currently looking at hedging a payment of 18,250,000 euro to a German supplier. Let's understand the scenario first. This is a US company. Right. Today is 1st of March. Okay. On 1st of August, they have to pay 18,250,000 euro. So the company's requirement is to buy euros. They need to buy. Then only they can pay to the particular supplier. So remember in mind, the requirement is company needs to buy euros. How many euros? This much, 18,250,000. They don't have euros because this is a dollar-based company, US company. Okay. Now let's go back to the question. The following market data have been obtained. Exchange rates are given. Spot rate. Okay, some of the students always have this confusion. When spot rates are given, exchange rates are given as a spread, whether we should take the lower one or higher one. Right. Don't memorize it, go with the logic. Look at this, how they have given it, 1.1483 to 1.1497. That's a spread they have given per euro. Where do I know per euro? Here on the top, quoted as US dollar per 1 euro. It's per euro. Understand, this is the price of euro they are talking about. Price of euro. If somebody says $2 per apple, they're talking about the price of apple, isn't it? So per what? Per euro. This is the product, or this is the underlying asset of which the price is given here. Each euro, this is the price. So like an apple trader will buy and sell apples, here bank is buying and selling currencies. So bank has to make profit, means bank will buy euro at the lower rate. This is bank buys euro, and this rate bank sells euro. Makes sense. Look at this. They buy for the lower price and they sell for a higher price. What is our requirement? We need to buy euro. We need to buy euro means bank has to sell us euro. Bank has to sell us euro means this rate is applicable. The higher rate is applicable. We are buying the euro from the bank. Bank always sells at the higher rate. Okay. So spot rate is given, forward rate is also given. So in both cases, we will take the higher rate only. Currency futures, contract size is given, this is given, currency option is given. In this page, there is a mistake, typo. The exercise price is missing here. This should have been 1.1540. right? In the original question it says 1.1540. Here it has been missed. So please, if you have this book, include that in your book, 1.1540. All right. Then exhibit 2 is the alternative exchange rate scenarios. So they are considering two scenarios on 1st of August. On that settlement date, one scenario with certain spot rates and forward rates, another one with certain different spot rates, forward rates and futures rates. Okay. Part A, recommend on financial grounds a hedging strategy for 250,000 euro payment using the market data available on 1st of March. So don't consider this information. Exhibit 2 is not for that part A. And assuming the options are exercised. Assume basis diminishes to 0 at contract maturity at a constant rate based on monthly intervals. 9 marks. That's the usual requirement. I don't see anything new in that. Let me take a new page. Okay. Start part A. I don't know from where this font comes. Let's change this. I would prefer, say, Calibri. Yeah, okay. Okay. First, we'll start with the forward contract. Forward contract. So the net cost to the company, they have to buy euros. So how many dollars they are going to spend? Net cost under forward contract is going to be, look, they have to buy 18 to 50,000 euro. The rate is given dollar per euro. We already decided we will take the higher rate. Forward, 5-month forward. Why 5 months? 1st of March to 1st of August, it's 5 months. March, April, May, June, July. August is not included because 1st of August you are paying 5 months. Higher rate is here 1.544. 1.1544. This is going to be the working. Euro will be cancelled. 1 euro is up, 1 euro is down. Cancels, you get dollars as the answer. So working is going to be 18 to 50,000 multiplied by 1.1544. This many dollars. This many dollars. Finished. Forward contract finished. Futures. Futures, what am I going to say? Company needs to buy euros. Contract currency is euro. Maybe I should write that first. Contract currency is euro. So I have to think in terms of euro. Company's need is to buy euro. Therefore, by September futures to start hedging. Some of you might have forgotten these basics. Remember, futures hedging, either you can buy now and sell later, or else sell now, buy later. Which action we are going to do for this hedging? We need to decide that, and we need to include that in the answer. How do we decide that? First, check the contract currency. I said contract currency is euro. How did I say contract currency is euro? Go back and see how they have given the contract size. Contract size is 125,000 euro. That's why contract currency is euro. And company's requirement is to buy euro. Remember, company's requirement to buy euro. So if the requirement is to buy the contract currency, future should be bought first. If you remember like that, it's easy. You will not make mistakes. Suppose if the requirement is to sell euros for the company, then they should sell the futures first and buy it later. Then only the hedging will be appropriate. That means in the spot transaction, if you make a loss, the futures transaction will give you a gain and it will nullify the effect. Okay. Now, next step is number of contracts. Number of contracts. Number of contracts, 18 to 50,000 euro is the requirement for you. Contract size is 125,000 euro. You are lucky, this question is easy because both are in the same currency. Transaction size is in euro, contract size is also in euro, so it's easy for you. Divide it. In my last video, I did a question where the contract size was in a different currency. So in futures, you need to find the lock-in rate. Using the lock-in rate, convert the transaction size to the same contract currency, then you have to find the number of contracts. Please check that also, because half of your questions might come like that. Be prepared for that. 146. Double check whether there are any decimals. If there are any decimals, you have to round it off. No. Exactly 146. So it's going to be a perfect hedging. No over hedging, no under hedging. Again, you are lucky in this question. Why? If there is an over hedging, under hedging scenario, that amount has to be managed by, or that amount has to be hedged by forward contracts. Here, there is nothing like that. It's perfect hedging. Perfect hedging. That means you get exactly whole number of contracts. Done. Then we can find the lock-in rate and finish the deal. How do you find the lock-in rate? Spot rate, futures price, the difference is basis. I usually do it in a table format. First you include today's rate, 1st of March, then the settlement date, 1st of August, then the expiry date. You are talking about September futures, 30th September. Remember, 30th September, on the expiry date, basis has to be 0. Spot rate today, 1497, 1.1497. Futures price here, 1.1560. The difference is basis. I always say, if the rates are given in 4 decimals, basis also has to be in 4 decimals. It can be less than 4 decimals, but not more than 4 decimals. So better you keep it exactly in 4 decimals. Okay, 0.0063. Why I said less than 4 decimals? Sometimes if the 4th decimal is 0, you will see only 3 decimals. Look at this one. So sometimes that might happen, but never ever more than 4 decimal. If you get more than 4 decimal, when you do the calculations, you must round it manually and write it. What I mean by manually is don't trust the rounding in Excel, because Excel will show the rounded figure, but within that cell it will have the full figure. When you make reference to that cell, it will take the full value, not the rounded value. Let's see in this case. Okay, months. Check the month calculation, 1st of March to 1st of September, or 30th of September. March, April, May, June, July, August, September. 7 months. Here August and September are remaining 2 months. So how do you find unexpired basis? This basis, divide by 7 to find per month how many basis points, multiply by 2 remaining months. Check the decimals. Okay, it has only 4 decimals. The others are 0. After 4 everything is 0. Fine. Then I can say lock-in rate, opening futures price plus unexpired basis. Opening futures price plus, opening means first, like 1st of March, today's futures price plus unexpired basis. Done. So how the futures transaction effectively would be working? Effectively, it's not the real transaction, it's not how the transaction is actually done, but the impact is going to be like this. The company and counterparty, you pay dollars to buy euros. Euro, how much are you going to give? 125,000 euro you will get. For that, how many dollars you have to give? 125,000 euro multiplied by lock-in rate. Effectively, that's going to be the lock-in rate. 1.1542 per euro. Euro cancels, you get dollars. This is one contract. Similarly, we have 146 contracts. So if I ask you how much is the cost for your company, this amount multiplied by 146 contracts. So net cost in futures hedging is going to be, I can do it here, 125,000 multiply 1.1542, multiply 146 contracts. If there had been an over hedging or under hedging, for that amount forward contract must be used. Here there is nothing like that. 21, 64, 150. 21,064,150. How much was it here? 21 million. You must get quite close answers. If you get massively different answer, you must understand you made some mistake somewhere. You can double check your working. So it's quite close. 21, 67, 800. Yeah, 64, 150. Around, yeah, 3,650 difference. That's fine. That's fine. Futures. Let's go to options now. Options. If futures, if you said buy here, in options you're going to say call option. If futures were to sell initially, then you need put options. Here let's say company needs to purchase or obtain September call options. Number of contracts, same, we already found it. Careful, futures number of contracts and options number of contracts, will it be always the same? No, it won't always be the same. When will it be different, or when could it be different? When you find the number of contracts here, see, the currencies were same. If currencies were same, what currency? Transaction currency and the contract currency, if they are same, then the calculation also is going to be same under futures as well as options. Suppose if contract currency was in a different currency, then you have to convert this to contract currency, not the contract currency, transaction. If the transaction currency was in a different currency, suppose let's say this is given in dollars, whereas this is euros, then what do? Transaction amount need to be converted to contract currency. How do you convert that? In futures you use lock-in rate to convert it. In options you use exercise price or strike price to convert it. This might give you different number of contracts. I remember I have done one question that is there in my channel. Check that in risk management. Probably the last video I uploaded was like that. Check that please. Okay, so in this case it's going to be same. E10, number of contracts 146. That is done. So we can find the net cost here. Option premium, September call 0.69 cents per dollar. So look at this, 0.69 cents per dollar divided by 100 to make it dollar itself. 0.69 cents per euro, sorry, 0.69 September call option here, cents, that cents I divide by 100 to make it dollar. 100 cents is $1. Multiply that by 125,000 euro. So this will give you, excuse me, one contracts option premium. You want to see this? Look, 0.69 divided by $100 per euro, multiplied by 125,000 euro. Right, now the euro cancels, you get the answer in dollar. This is for one contract. Multiply this by 146 contracts. This is the option premium, this is the cost for you. Then assuming the options are exercised, same as futures. Futures, you said, okay, you are getting 125,000 euro and you are giving dollars. How many dollars you are giving? You converted this using the lock-in rate. If it is options, you don't use the lock-in rate. There is no lock-in rate as such. You use the exercise price or strike price. So it's going to be company, counterparty. They give 125,000 euro. They give 125,000 multiplied by 1.1540. Remember I told you in this question, There's a typo. They did not type this exercise price here. Should have been 1.1540. As I have seen that in the original question, I'm telling you. Right. So the company's cost is going to be cost of exercising 125,000, 1.1540. This is for one contract multiplied by 146 contracts. So total cost is going to be this. Both are cost. Option premium is the initial payment, and this is also the when you are exercising, you are going to pay net cost. Dollars. Right, all three are done. So you can give the recommendation. What recommendation you're going to give? The option is quite expensive because 21,064 versus 21,186 means 122,000 almost. You can get the difference. How much is the difference? This minus this. 122,000 is quite significant. So unless there is high probability of favorable movement in exchange rate, you should not consider options. Right? Then among these two, futures and forward contract, amount is almost same, very small difference. Considering the lower default risk in the exchange traded items, futures hedging might be preferable for the company. So give a justification and finish it. 9 marks ready. Now let's go to part B. Evaluate the impact on the results of using 3 hedging instruments being considered if the rates and futures prices are as per scenarios 1 and 2 on 1st of August. Right, this is what I said. A different requirement this time. What is scenario 1? Spot rate is this on that day. 5-month forward. Look, on 1st of August, what is the 5-month forward? Doesn't matter to me. That is, if somebody is going to enter into an agreement for a 5-month forward from 1st of August, that doesn't matter to me. Leave that. Currency futures prices are given to us. Right, let me anyway copy this. Scenario 1. I'll take this information to my working. Okay, part B. Scenario 1. Whatever happens, forward rate outcome never changes. Whatever the exchange rate, forward is a binding contract. Whether the market is favorable, unfavorable, there is nothing you can pull out from it. So nothing will change. The outcome of forward contract will be the same as in part A. Simple. In scenario 2 also you can say that forward contract outcome will never change. It's the same. What will happen to the futures contract? Theoretically, futures contract also outcome cannot change. Theoretically it cannot change. But there is one issue which is basis risk. What is basis risk? If you go back and see the calculation here, we assume unexpired basis is going to be 18. So what is our assumption here? From 1st of March, if I take time in my x-axis, 1st of March to 30th of September, the basis, if I look at the value only, if I leave the minus, from 63, it comes down to 0 linearly, straight line relationship. Every month it falls by equal amount. This is an assumption. Due to several factors, this linear relationship might not happen. One basic requirement is the basis, the supply, demand and supply of the currencies, demand and supply of the other derivatives, interest rate fluctuations, unexpected market events. Likewise, there can be several incidents that can challenge this straight line assumption. So now I need to check whether this 18 basis points or unexpired basis 18, this assumption, if it is right or not based on the new information I have. If this was right, then my workings for futures will still be the same as part A. Suppose based on the new information I have on 1st of August, if the basis is not 18 points, if it is more or less than 18 points, then my working in part A is not perfect. So how do you check that? Simple. Look at this. On 1st of August, what was the spot rate as per the latest information? Here we have copied spot rate 1534, 1.1534. What's the futures price? Futures price 1.1552. Get the basis points. 18. This is the same amount we had earlier based on our estimate. Here 18. So here I can conclude now, since the unexpired basis calculated in part A is same as the basis on 1st of August based on actual information. Let's put it into two sentences. What? The unexpired basis calculated in part A is same as the basis on 1st of August based on the actual information. Therefore, the calculated outcome of futures contract in part A is still valid. Right, the next one, let's see options. This is futures will be same. Options I need to decide, since I have the new information, we need to check whether the option will be exercised or not, because earlier we didn't know what is going to be the rate on 1st of August. So we assumed option will be exercised. This calculation we assumed option will be exercised, and we did this. But imagine if the market rate is favorable than exercising the option, you're not going to exercise the option. Let's check that here. Spot rate is here $1.1534, 1.1534 per euro. That's a spot rate. Whereas strike price or exercise price $1.1540. So definitely spot rate looks better. So we can say option will not be exercised. So if option is not exercised, what are you going to do? You will exchange it in the spot market. So spot market cost is going to be 1.1530, 18,250, 1.1534. This rate. Don't forget there will be premium. Premium is anyway paid at the beginning. Whether you exercise the option or not, premium is going to be paid. How much is the premium? Same premium we found earlier. This one, option premium. So net cost is going to be this much. We don't have to comment about this. They simply asked find the outcomes. So forward in scenario 1, forward and futures no change. Again forward guys, forward whatever happens there is no change. Futures, as long as the assumption about basis remains valid, futures also no change. Options, we need to check whether it will be exercised or not. In this case, option will not be exercised, so answer is going to be different. Now let's check scenario 2. This one. I'm just copying this data so that I can easily refer to it. Scenario 2. Again, you can say outcome in forward contract will not change. Futures. What did we do for futures in scenario 1? We check the basis. If the basis remains the same, that means 18 points, it will be okay. Check the spot now, 1549. Futures 1563. There you go. The basis is not 18. This is what we mean by basis risk. You assumed basis is going to reduce linearly and the basis will become 0 on the expiry date. But that assumption is challenged now. If that assumption is valid, the basis should have been 18, but now we have 14. The basis is 4 less, right? The futures price should have been 1.15. Imagine, okay, 1.1549 is the spot rate. If you wanted to have minus 0018 at 18 here, answer should have been 49 plus 18 would be 67. This should have been the futures price if my assumption is right. But the futures price is 63. What kind of trading we are doing on futures? Buy futures now and sell later. So this sell price should have been this 1.1567. Instead of that, we have 1.1563. Can you see? Sell price is lower. So gain on futures is going to be low by 4 basis points. 4 basis points. That means if gain is less, my overall cost is going to increase. Repeat, we are doing a hedging where we initially buy and sell later. Buy price is fixed, that is on 1st of March. 1st of August, as per our calculation, as per our expectation, if spot was this, the futures price should have been this 1567, so that this 18 basis points assumption remains valid. But that was different. Basis is only 14. If basis is 14, the futures is 63 as per what they have given. So you can see the difference. 67, 63, 4 points less. Selling price is 4 points less. Selling price is less means gain is going to be less. Gain is going to be less in this means overall cost is going to increase for the company. So let me say, since the basis is only 14 points, the overall cost, let's say, or I can even say the gain on futures will fall by how much? One contract size is 125,000. 0.0004. This is the loss on one contract multiplied by 146 contracts. 7,300 additional cost is going to be there. Gain is reducing means additional cost. So the revised net cost using futures will be whatever the answer we got already plus 7,300. Here futures answer we got how much? This price. Net cost in futures was this plus that 7,300 plus 7,300. Okay, this is what you call basis risk, right? Then that's about futures. Options, how do we do? You take the spot rate and futures, compare it. See what we did here, spot market and strike price. Spot rate, strike price is same. Spot rate now is 1549. Which is better? Strike price is better. Paying this cost is better than that. So option will be exercised. Option will be exercised. Option will be exercised. If option is exercised from part A, there is no difference. No difference in outcome. From where? From part A. Okay. Why in scenario 1 it was different? Option was not exercised here. So I had to recalculate. but now option is exercised. Part A assumption also option was exercised, so it will be the same outcome. Clear? So the learning is forward, futures and option. On the transaction, on the settlement date, if you get to know the actual spot rate and futures price, futures, see whether your assumption about basis points, unexpired basis, if it remains the same, then your futures calculation initially would still be valid. If the unexpired basis and the actual basis on the settlement day are different, then your calculation would have gone wrong. Either you might get a gain or loss. In this case, the basis points was lower, so we got a loss. That also you need to check, buy, sell, accordingly you have to check. Here I said selling price has gone down. Selling price has gone down means you are losing. Right. Option, what do we do? On the settlement day, compare the spot rate with your exercise price. If the spot rate is better, option will not be exercised. Then answer will be different. If the spot rate is not good, if the exercise price is still better, then you will exercise the option, then answer will be same as earlier. Part C. Explain what is meant by basis and basis risk and discuss the impact of basis risk on the hedging decision being considered in A and B. Well, I already have explained. First explain. Look at the questions one by one. I explain what is basis. So one sentence for that. What is basis risk? Another sentence for that. And then discuss the impact of basis risk in part A and part B. So there are 4 requirements. If you at least identify the requirements one by one and address them, you get the marks. Explain what is basis, 1 mark. Explain what is basis risk, 1 mark. Then how the risk has affected part A answer, part B answer, another 2 marks, 4 marks. One of these points will give you 1 extra mark, 5 marks. Right. So what is basis? You will say the difference between spot exchange rate and the futures price on that day is known as basis. What is basis risk? The basis point is expected to reduce linearly over time, and on the maturity date it will become 0. This is the usual assumption. However, in reality, due to several factors such as you can say supply and demand and supply of currencies, interest rate fluctuations, unexpected events, due to several factors, the linear relationship between the basis and time may not happen. This is known as basis risk. Discuss the impact of basis risk in part A and part B. You can say in part A, there was no basis risk. The expected unexpired basis and the actual basis on that day were exactly the same. Therefore, the initial calculations still remained valid. Whereas in part B, the basis, unexpired basis was less, the actual basis was less than the calculated unexpired basis. This gave a difference. This difference can be sometimes on the positive side, sometimes on the negative side, giving a gain or loss to the hedging company. In our example, in this example, it had been a loss. Done. That is the 5 marks. Clear? So I don't think part A is difficult for you. Part B is what is new. Please revise all that and let me know if you have any doubts or any more challenges in this. Thank you.